Hello and welcome to your presentation on capital investments. So learning outcomes for this section of the semester is to understand what the purpose of capital budgeting is, know how to complete a relevant net cash flow analysis, how to complete a payback period analysis, and then finally how to complete a net present value analysis. So capital investments. Capital investments are really money that's invested in a business in order to further business objectives. Typically, a business objective would be either to save money or to increase revenues. Okay, so if you can save on your expenses or if you increase revenues, that would be the main reason why you would invest in something for your business. We're typically talking about, in this case, acquisitions or purchases of any fixed assets, any big fixed assets like land, buildings, and machinery. Okay? Assets that are expected to be productive over many years, not just 1 year. So capital investments are going to include purchasing a new property, purchasing a building at a new location, buying new equipment, starting a new business. Essentially any large asset resource that's going to add to the long-term profitability of a company. And that's what a capital investment is, when you're making an investment that's going to help your company further itself. Now, capital investments, they require a bit of a balance of risk versus reward. The lower the risk, the lower the reward. The higher the risk, the higher the reward. And now this may be difficult for some to understand, so if we go through some examples, let's think about if you keep money at home. So the risk is very low, other than obviously a roommate or someone taking it, but really it's very low for you to just keep money at home, the risk. The reward though is, are you going to get any money back? Are you going to make any money from that money sitting at home? No. And so low risk, low reward. A bank savings account, if you put it in there, you might get 0.5% interest or 1% interest. So you're not getting too much money back. So fairly low risk, fairly low reward. The stock purchase is when you're purchasing shares of a company. Now you start to get into a bit more moderate risk, where if that stock price starts to go down, you start to lose money. So the risk is moderate, but when this company is doing well and your stock price goes up, your reward will be moderate to high. It could go really high. And then if we think about entrepreneurship, so you owning your own business, the risk can be very high, because if anything goes wrong with that business, it's on you. So therefore, it's very high risk. But if your business is successful, then you could be making a lot of money. And because you've started your own company, you're making a lot of money yourself. So that's just a couple of examples of how to understand that with low risk, you have low reward, but as risk increases, there's the possibility of a higher reward. It's just finding that right balance of what you can handle. So capital investments, what we end up doing with any big capital investment is we complete an evaluation of it, whether or not we should actually make this investment. We really call this capital budgeting. And what this is where we're evaluating a project's cash outflows, so how much the investment is, and then how much of a return we're going to get. So really, how much will it cost and how much return can we expect? We want to make sure that we're going to actually make enough of a return to actually make sense. So we're not going to invest in something that's not going to give us a return. So if we're not going to make our money back, why would we invest? Okay. So the process, we need to determine project-related future incremental net cash flows. And that's what we call a relevant cash flow analysis, where we're going to figure out how much money this is either going to save us in the future or how much more revenue it's going to make us in the future. We then need to evaluate our incremental cash flows against the investment. So we do this in this class in two ways. We evaluate how long it's going to take for us to make our investment back, so that's the payback period, and then the net present value. So what is the net present value? How much of it are we going to actually make back? And then the internal rate of return, and the terminal rate of return we will not cover. So what we're really evaluating here is cash flow. Now, we're not evaluating accounting profits. Accounting profits is simply revenue minus expenses equals profits. Okay? Cash flow, we're only looking at the money that this investment's going to bring in. So cash flow directly linked to the investment, not net income, cash flow. Okay, so anything that's directly linked to the investment. So not revenues minus expenses equals profits, because we might be talking about savings that it's going to give us as well. So the incremental net cash flow analysis. It's where we're determining the net after-tax impact on cash flow when making a capital investment. Now, we're not only going to take a look at the fact that this investment's going to make us money or save us money. We need to know, after we account for all costs directly related to that investment, how much money are we truly saving or truly making. So the information we need is any incremental savings or new revenues generated from the investment for each year that you're evaluating. We need to complete a capital cost allowance and UCC calculation for that capital asset. We need to know all costs that are associated to the investment, and then we need to know an income tax rate. So let's go through an example. Let's say I want to purchase a new $10,000 refrigeration system for my restaurant. It's going to allow me to save $2,500 in labor and $1,500 in utility costs each year. That would probably be the fact that I'm going to have to pay someone less to come in and fix my old refrigerator, and it's more efficient, so I'm going to save more on utilities. So it sounds like it makes sense. The system requires annual inspections at a cost of $500 per year, so I still have to pay $500 per year, and the capital cost allowance for the equipment is 30%. The tax rate I typically pay on any revenues or any savings is 32%, and we're going to use a 7% discount rate to measure the value of this investment over the next 5 years. We'll touch base on what that is in a second. So we need to complete a relevant net cash flow analysis first, then a payback period analysis, and then a net present value analysis in order to understand what this investment really means. So it's not really going to be the fact that it's going to allow me to save $2,500 and $1,500. That's not going to be enough because I have costs that are still associated. So I need to make sure that this really makes sense. So the first thing we need to do is complete a capital cost allowance evaluation, or a chart basically, where we need to, and in this case we're going to evaluate it over 5 years. We need to go back to what we covered in week 2 or week 3 and how to complete capital cost allowance calculations. So in year 1, the depreciation expense, the CCA deduction that we're allowed on this asset, is simply our $10,000 times 30%, but remember the half-year rule in year 1. We can only depreciate half of that amount in year 1. So 10,000 times the 30% times 50%. That would be how much we're allowed to deduct in year 1, $1,500. And then we go our 10,000, how much our asset is worth at the beginning of year 1, minus the CCA deduction for year 1, to figure out that we have at the end an undepreciated capital cost of $8,500. And that's at the end of year 1. This automatically becomes our UCC, our undepreciated capital cost, at the beginning of year 2. And then we would start everything all over again. So our CCA deduction for year 2 would be our $8,500 times the 30% rate. So that would give us how much we're allowed to depreciate in year 2. And then our beginning $8,500 at the beginning of year 2 minus that expense would give us $5,950. And then we continue to do this over and over again for the 5 years. And we really need our CCA deduction for all 5 years. And we also need the undepreciated capital cost at the end of year 5. That's the information in yellow that we're going to need moving forward. Okay, but we need the undepreciated capital cost throughout the years to continue to do this calculation. Now that we have that information, we can start to build an incremental relevant net cash flow analysis. So you'll notice that we have every year at the top, okay, because we want to see for every year what happens. The savings of $4,000, if we go back to this slide, the system will allow me to save $2,500 in labor and $1,500 in utility costs each year. So if we add them together, By purchasing this refrigerator, I'm going to save $4,000, and all I did was add those two savings together. So every year I'm going to save $4,000 is what this investment is saying. My operating expenses, if we go back to the example, the system requires annual inspections at a cost of $500 per year. So we want to make sure that we account for that. It's going to cost me still $500 every year to inspect it. Then we also need to subtract our depreciation so that we can account for it with taxes. So depreciation expense is simply just all of our CCA deductions for each of the first 5 years. So the $1,500, $2,550, you'll see that we've just put them in this line. Okay. So if we go our savings minus any expenses that are attached to that investment minus our depreciation, we'll get our net savings before tax. Okay. So that's how much we'll save each year before tax. Then we would calculate our 32% tax, which is simply the situation that was explained in that question, to figure out our tax. To then discover, we'd subtract that from our net savings before tax to discover our net savings. So $2,000 minus our tax, and all we did to find out our tax was our $2,000, which is our net savings, times our 32%. To find out our $640, and we subtract that from our $2,000 now to find out our net savings here. And we would do that for each year, our net savings for each year times our 32%, and we would subtract those taxes from those net savings. We would then add back this depreciation, okay? Because if you remember, we discussed this in class in week 2 or 3 and this week in class, the fact that this is simply it's not really an expense. You've already purchased this car. This is just the expense that you're allowed to account for over the useful life of this asset. So we want to add it back to see really how much cash flow we're really going to get from this investment from year to year. Notice that it went from it's going to provide us $4,000 in savings to really, after we account for operating expenses, for taxes, and we add back our depreciation, it's really $2,860 in year 1, $3,000, almost $200, and so on and so forth. Okay. So that's how we would complete a net cash flow analysis. We start with any increase in savings or increase in revenues. We subtract any directly related costs, and we subtract our depreciation to find out what our net savings before tax is, or net income before tax if we're talking about an increase in revenues. We then calculate our taxes, subtract them from our net savings before tax to find out our net savings or net income after tax if we're talking about revenues. And then we add back our depreciation to find out a relevant net cash flow for each year. Another video will go through another example with you. So the payback period analysis now is where we look at how long it's going to take for us to make our investment back. So the only problem is it doesn't account for the fact that this is money in the future, and our dollars today are not the same amount. This is worth completely different amount of dollars now compared to the future. Okay? So how long to pay back the $10,000 asset is really what we want to find out. Okay? So if we go through this, we would basically just want to continue to add up each year to a running total, to find out when we get back to this $10,000. How long does it take me in years to get back to $10,000? So in year 1, we make to the relevant net cash flow, and all this is all of our relevant net cash flows from the bottom here. So in year 1, I'm making $2,860 after I account for all the costs and the tax and everything. That's how much my investment is going to create for me in savings. So at the end of year 1, my running total is $2,860. In year 2, I have relevant net cash flows of $3,196. So I would add that to my running total from the previous year to find out that after year 2, I've made $6,056 back. So I'm not quite at $10,000 yet, right? Then in year 3, I would have $2,951 that I would make back. So now if I add that to the running total from the previous year, I've got $9,007. I'm very close now to $10,000. I've almost made my investment back. So it's going to take me 3 years. And then at some point in year 4, I'm going to actually make my investment back. Okay, and I know that because $10,000 minus $9,007, I'm missing $993 to make it back to this $10,000. That's what I'm doing. So I would then take my $993, which is what I've left to make, and I would divide it by how much relevant net cash flow I'm supposed to make in year 4, 2,780. That would give me a decimal, and I would just add that to the 3 years that it's already taking me. So it'd take me 1, 2, 3 years plus how long it takes me in year 4, so 0.36 years. Okay. Now, some people will say that they want to make their money back in a certain amount of time. So if I told you I want to make my money back in 4 years, I want this investment to be returned to me in 4 years. This is 3.36 years. Yes, you should definitely make this investment. But if I said I want this investment to be completely returned by 3 years, well, this is going to take 3.36 years. Now I have to think about this investment. I'll probably say no. Okay. And then we have our net present value analysis. So this is where we calculate the net present value of an investment's future net cash flows and undepreciated capital costs compared to its initial cost. So we need our relevant net cash flows, which we've already completed, our undepreciated capital costs at the end of the period, we have that, the initial investment value, and a suitable discount rate. Okay, so we need to really discount future net cash flows to today's dollars. So what we have to do is we need to figure out the fact whether or not, not whether or not, we have to figure out how much those cash flows are, but in today's dollars. Okay, because money, our dollar today, doesn't have the same purchasing power as later on. Things are going to be more expensive as time goes on. Okay? So we're going to use a discount rate. We're going to use a percentage to see what it is worth in today's dollars. Then we're going to add up all those cash flows in today's dollars. We're going to put the undepreciated capital costs at the end of year 5 in today's dollars. And then we're going to calculate the net present value of our capital investment. So let's go through each step. So first, discounting. If you think about it, $100 in your pocket today is not worth the same as $100 at the end of the year or $100 in 5 years. So what we do is we're going to want to put all of these cash flows into today's dollars. If you think back at how much a chocolate bar cost you, a chocolate bar would have cost you $1 5 years ago, it's now $1.50. So your dollar back then had more purchasing power than it does now. Okay, things are more expensive. So there are 3 ways you can discount future net cash flows to today's dollars. So 1 is using a formula, 2 is using a discount factor, and 3 is using the present value function in Excel. I'm going to show you primarily number 1 and number 2. So we want to discount future cash flow to today's dollars using either the formula, which is future value, so our future value of our cash flows, divided by 1 plus R. R is the rate. Okay, so if it's a 7% rate, we would put 0.07 to the power of the time, what year. So in this case, it would be 1. The easier way, and the way that I'll probably point you towards, is the discount table. It's not on page 640. I have provided it to you. It should be future value times the discount factor. So I'll show you the one for Brightspace in a second. So let's discount some net cash flows using the given rate of 7% as our discount rate. So if after year 1, I believe this investment's going to provide me with $2,860 of net cash flows, I can either use the formula 2,860 divided by 1 plus 0.07, which is my 7% rate, to the power of 1 because I'm looking at year 1. Alternatively, I can use the factor. And if you go to your Brightspace, you'll see the discounting table, and this will be provided to you on your final exam on a page. It should be coming up anytime now. There you go. So this is a discounting table. So the upper row is all the discount factors. Okay, so the percentages, and this is by year. Okay, so all you have to do is match them up. So I'm saying that 7% is the discount rate that I'm using, and I'm first of all figuring out my present value of my cash flow from year one. So 0.935 would be the rate that I want to use. And we'll just do this. So I would multiply it by, in this case there's more decimals, but simply just use, we could use 0.935, I believe is what was used. Yeah, there you go. And then I would do the same in year two. So I'd multiply my relevant cash flows from year two times the U factor for year two. So we'd go back and we'd say, okay, 7% is my rate, but I'm looking at year two, so 0.873. So we'd go back and we'd multiply by 0.873, and again, simply use what's in the actual table. Okay. And we'd continue to do this for multiply our net cash flows from each year times the appropriate cash flow factor, so the discount factor. Okay, so you'd continue to go 7% year one, 7% year two, 7% year three. We'd use this number, 7% year four, 7% year five. Okay. And we'd multiply them. And then this would give us the net cash flow over the years, but in today's dollars. Notice how they're all lower. That's because our dollar today, everything's going to be more expensive later on. Okay, so our dollar today is worth less than it will be. Well, we can purchase more with a dollar today than we will be able to later on. Okay, so we're basically just transferring these into all of our net cash flows in the future to today's dollars. So now we have the present value of all of our net cash flows. Now we want to add up all of these cash flows. So we've gone ahead and we've completed a net cash flow analysis. We've turned it into today's dollars, present value of what these future cash flows look like. And now we want to simply add them up to see how much our cash flow is in today's dollars. So remember, it cost me $10,000, and if I added up all the cash flows, the future cash flows, but in today's dollars, it's telling me my investment's going to make me $11,890.66 over 5 years. Okay, so let's remember that. Now we need to then complete the same kind of calculation, but for the our undepreciated capital cost at the end of year 5. Undepreciated capital cost is really what our capital asset, our investment, is going to be worth, but in year 5, at the end of year 5. So if we go back and we keep on going back, it's worth this amount at the end of year 5. Okay, so that's how much it'll be worth at the end of year 5, but if you remember, we need to make sure that we turn it into today's dollars again. So we would simply go how much our undepreciated capital cost is multiplied. We can do 1 plus the rate, which is 7%, to the power of 5 because it's the 5th year, or we can simply go multiplied by the factor. Okay, so if we go back, we could see in our, I must have closed it, discounting table, if we go 7% and match it up with year 5, 7.713, and that's where that came, 7% year 5. Okay. And then we would have our undepreciated, the value of our investment at the end of year 5, but in today's dollars is what we're doing. Now we can finally complete a net present value analysis. That's the step 4, and that's where we go the present value of our net cash flow. So all the cash flows that this investment is going to provide me in today's dollars, we're going to add the value of the asset at the end of the 5 years that we valued in present dollars, and then we're going to subtract our initial investment. If the net present value, this final number, is positive, the investment meets the criteria, and we should go ahead and make this investment. So in this case, we would add the total of our present value of our net cash flows plus the present value of what the investment will be worth at the end of year 5 minus the initial investment, which was $10,000. That would give us a net present value of $3,345.76. It's above zero, so this is a good investment. Okay. So what you need to know as you move forward for this class, for projects, because you should know this as you go out into the industry and for the final exam, is how to complete a relevant cash flow analysis, complete a payback analysis, and how to complete a net present value analysis. There will be a video after this that covers how to complete this again, another example using this example right here. So please feel free to watch it.